Namaskar everyone, welcome to this session. So in this session, after learning the basics of Excel, now today we will be making a simple model. So this will be on a hypothetical company which has just started its operations, and we have the data available and the expectations of the management available, the plans available here. So on the basis of this information, we are going to make our model. So let me just show you how it may look like. It may look like this. There will be one assumption sheet, one profit and loss statement, one balance sheet, one cash flow statement, and then one final output sheet we will make. So here, if you just look at the cash flow thing, this is the cash flow we have made. This is the balance sheet we have made. This is the profit and loss statement we have made, and an assumption sheet or OCA. Yes. So like that, we will build first an assumption sheet where we will be doing our workings here, and after that we will build one profit and loss statement, balance sheet statement, and cash flow statement. And remember, the important thing here is that the point to notice is that we do not have any historic data. We just have, it is like on this particular financial year. Let me just show you the example. So on 1st of April 2022, this company has just started their business and we have their data available. Now we have to work on it. So it is for a newly formed company who doesn't have any past data to analyze, to do the trend analysis and this kind of stuff. So for a newly formed company, how we are going to look at it, how we will make a model for just a newly formed company, we will learn that today. And whatever we will be learning today, I can assure you one thing, that this will help you to build a strong base on the basis of which you will be able to make a model for the companies which are operating in the market for quite some time. They have the historic data and everything. So we will make a model first today and show you. Then in the next session we will take an example of any company which is already existing, which is already in their operations. We will teach you how to make their projections there. But this particular session is going to be very, very important, because if you do not get this session correctly, then you will not be able to make a model on that company. So today's session is very, very vital, very much important. So let us read about this company. EVS Private Limited. I have just taken a random name here. EVS Private Limited started its operations to manufacture product A on 1st of April 2022 with an authorized capital of rupees 20 lakh, that is rupees 2 million, that means 20 lakh. And how many shares are authorized? 2 lakh shares of rupees 10 each are authorized. So now in this business there are 4 promoters who are starting this business by contributing 5 lakh rupees each for 25,000 shares. Now wait, just do a little calculation. There, all these promoters are going to contribute 5 lakh rupees each, and the number of shares that they will be getting is going to be 25,000 shares. And here the face value of the shares is 10 rupees. So then why these promoters are contributing to the business some extra money? Because this is going to be treated as the securities premium. Okay. The 4 promoters of the company contributed 5 lakh rupees each for 25,000 shares issued to each one of them, that is each one of the promoters. In addition to the contributed capital of 5 lakhs each, that means totaling 20 lakh. In addition to the 20 lakh rupees of equity capital, they are raising a debt of 15 lakh rupees at an interest rate of 10% per annum from HDFC Bank on 1st of April 2022, which is the day of starting their operations. On the first day, they are raising one loan of rupees 15 lakh at an interest rate of 10%. The interest rate will jump to 12% in case interest coverage ratio for the company if it falls below 8.50x. Then the interest rate will jump to 12%. Now what is this? What is this interest coverage ratio? That means how much money do you have, how much money you are generating to pay off the interest, how much times it is. So I will explain this thing later on while we will be working on it, so you don't have to be worried right now, but this is the basic thing. It is like how much EBIT you have, what is the times of EBIT you have to pay off the interest. The management and bank has agreed to contract. The management and the bank has agreed into a contract where this company EVS Private Limited is exempted from making any payments of debt in the first year of operations. तो पहले साल में promoters कोई भी पेमेंट, कोई भी लोन का इंस्टॉलमेंट बैंक को पे ऑफ नहीं करेगा. So they are not going to pay off any part of the loan in the first year of operations, although the interest calculation will definitely happen, but yeah, promoters are not going to make payment to the bank in the first year of operations. The terms of loan requires the company to repay minimum of 20% of the outstanding debt at the start of the year. Start of which year? Start of second year. Starting from its second year of operations. That means the bank has taken debt, let's say on 1st of April 2022. This is the timeline. Now on 1st of April 2023, they will have to pay 20% of the outstanding debt to the bank. For manufacturing product A, EVS Private Limited, so they are a manufacturing concern and they are planning to produce one particular product called product A. So in order to produce for manufacturing product A, EVS Private Limited spent 25 lakh rupees for buying two machines. So they have purchased two machineries worth of rupees 25 lakhs. On the second day of the year 2022, that is on 2nd of April, they have purchased two machines at this price. The yearly capex is estimated to rupees 2 lakh for second year and third year, and rupees 2,20,000 for the year 4th and 5th. So first year mein they have purchased this machinery for rupees 25 lakh. In the second year they are going to make a capex of, that is capital expenditure of 2 lakh. Third year also 2 lakh capital expenditure. Fourth year and fifth year they are going to make a capex of 2,20,000. Depreciation will be charged at a rate of 12% of the yearly written down value. So depreciation will be charged using the written down value or diminishing balance method. Now EVS Private Limited is expecting to achieve a capacity utilization ratio of 60%, while so capacity utilization ratio, that means they will be using these two machines and they are, let's say, going to produce 100 units. Let's say this company will capacity of this machine is to produce 100 units, but they will be able to produce only 60 units. For some reason they will be able to produce 60 units in the first year, and 60 units, out of that 60 units, 75% of the 60 units they will be able to sell it. That means how much? 45 units actually they will be able to sell. Now EVS is selling all the goods through a commission agency. That is, they have hired one agency to whom they are paying a particular commission for selling their goods to the customers. And and the commission rate is going to be 8% on the selling price. So let's say they are selling 45 units multiplied by 100. Let's say 100 rupees is the price for each unit, that is price per unit is going to be 100. So this commission agency will get a commission of rupees 8 per unit. Now the yearly indirect expenses like rent, salaries, office expenses, etc. are estimated to be 12,60,000. The goods are sold on credit and the company is expecting to recover its receipt from debtors in 40 days in the initial year. So that means in the first year they will sell these goods to their customers through this commission agency, and the customer will pay back our company EVS Private Limited after 40 days of selling the goods. So EVS Private Limited will sell, let's say on 1st of April they will sell the goods to, let's say, ABC Private Limited, who is the customer. Customer ABC Private Limited will pay the money to our company EVS when 1st of April को बेचा, पे बैक करेगा 10th of May को. So 40 days is the debtors period, which gradually is expected to come down to 30 by the 5th year of operations. So 5 साल business करने के बाद this debtors day will come down to 30. This our company EVS Private Limited is expecting this. So on the other hand, EVS takes about 60 days to make payments to creditors from whom raw material is purchased to manufacture the products. So now EVS is doing their operations. They are selling to ABC Private Limited and getting paid after how much? How many days? After 40 days. And EVS Private Limited is buying raw materials from XYZ Limited, and EVS Private Limited is paying to XYZ Private Limited after 60 days. So this is the debtors and creditors cycle here. So EVS has plans to give dividends to the shareholders at the rate of 25% in any year when the net margin is above 10%. So that means if the profit after tax margin, if the PAT margin is more than 10%, then this company is going to pay off dividends at the rate of 25% to its shareholders. Now a few things. Production capacity of production capacity of 1 lakh units. So this machinery can produce this machineries which this company bought by paying 25 lakh rupees. Their capacity is to produce 1 lakh unit. The utilization ratio in the first year is going to be 60, second 62, third 64, fourth 65, fifth year it is going to be 66% of capacity utilization. Sales of, and out of this 60% of production, how much our company will be able to sell? 75, 76, 77, 79 and 82% of total available units for sale. Now selling price of rupees 150 unit is going to be our selling price. Our selling price is going to be how much? 150 rupees per unit, and selling price is expected to grow by 7% every year. So next year, how much will be the selling price? 150 plus 7% of 150. Raw material cost rupees 60 per unit. Labor expenses rupees 27 per unit. Both of these expenses are expected to grow at 5%. Raw material price will go up by 5% every year, and labor expenses will go up by 11% every year. SG&A, that is selling, general and administrative expenses, to grow 15% for 2 and 3 years. That is first year mein there will be no growth in SG&A. Second year 15% growth. Third year 15% growth in SG&A. Fourth and fifth year 14% growth. Tax rate is going to be 30%. Creditors days to come down to 55 in the year 4th and 50 in the year 5th. From the 60 days period, it will come down to 55 after 4 years of operations, and in the 5th year it will come down to 50. Outstanding expenses account for 1.25 months. So outstanding expenses account for 1.25 months, that is we will pay them off after 1.25 months. We will calculate that. While we will be doing it, we will divide it by 12 and we will be doing the calculation. Then debt repayment at the rate 30% in year 3 and 4 and 35% in year 5. So debt repayment, how it is going to be: 30% in year 3 and year 4 and 35% in year 5. In the first year end, what we will pay? 20%. It was mentioned there. Then there is another question given here, which I will explain and take you through it later, while we are done with all this information. So let us now head on to the blank Excel sheet. You can see this is a blank Excel sheet, and here we are actually going to develop our today's model. So this is a blank Excel sheet. Now if you just open up last day's Excel sheet, which I shared with all of you guys, this is the Excel sheet I have shared with every one of you in the WhatsApp group. So now in our Excel sheet, here we need to add few more sheets here. Why? Because we have to make profit and loss statement, balance sheet and cash flow statement. So for that at least we need 3 sheets, and we need a sheet for doing all our workings, that is for our rough work. So we can call it an assumption sheet. So we at least need 4 sheets. So how you can do it? You can just add sheet manually like this, or what you can do is that, what is the shortcut? I have already given it to all of you guys. Insert new Excel sheet. Shift plus F11 you can do, and you can add one new Excel sheet. How to do it? So you will just anywhere in the Excel press Shift F11, Shift F11, Shift F11. So like that. Now how you can rename these sheets? You can manually do it as you used to do, but there is also a shortcut which I have already shared with all of you. How to rename the sheet? Rename the sheet. Alt H O R. By pressing Alt H O R. Let me show you how I am switching between this tab, Alt tab. So many tabs are open, right? I was working on this particular tab, which is the existing ones, and this thing. So Alt H O R, we can edit the names. Look at this thing, sheet 5. How I'm going to edit this? Alt H O R. Let me show it to you once again. While I am pressing Alt, in this ribbons, symbols are appearing. The shortcut keys are appearing by itself. So Alt. Now here it is showing H home. H I am pressing. O for format. You can see the format part here. O. Now R. I am looking for R. R you can see. The rename sheet was appearing. Alt H O. See the rename sheet R. So I am putting what name here? Assumptions. Assumption sheet. Press enter. Now I would like to edit this sheet 4. How to do it? First we have to go to this sheet. So control page down to move rightwards, control page up for moving leftwards. I have taught it to you. The shortcuts are already shared. So control page down, Alt H O R. What do I need? Profit and loss statement. So I'm just writing it PL right now. Shift page down. I need one balance sheet also. So Alt H O R, balance sheet. Just BS I'm writing the short form only. Control page down. Alt H O R. This thing, what do we need? Cash flow. See if I'm writing the short form only. Cash flow. Press enter. Now you are here. You can see this many Excel sheets are here. So I would like to add some dates on this each and every Excel sheet. Dates are not added here, so I would like to add some dates to it. And I want to do it in such a way that if I just add one date here, let's say in the D column, or I should say D1 cell, then it should reflect to all these pages. How to do it? So what we can do is that we can select all these Excel sheets at once and we can group it. So whatever we will be doing on one particular Excel sheet, it would get reflected on all the Excel sheets at once. So press Control, come down here. The assumption sheet is already selected, so just by pressing Control, click on PL, click on balance sheet, click on cash flow, and it has been grouped right now. So now we would like to add a date to this Excel sheets. What is today's date? It is June 7, 2022. So I'm just adding the same date here. June 7, 2022. Now let us check. Control page down, control page down, control page down. It has come to all the pages. Now I would like to group it once again because I need to do some more work as well. I would like to increase the size to 120% for better visibility. I will do one more thing, equal to EOM, end of month. Starting date will be this, comma, month will be 12. Press enter. So we have 2 years, 3, 4, 5. We will do Control R. Now these numbers are appearing. Now what is this? Let us change the format of it. How we can do it? Simply I'm just doing the short date part. So this is appearing, right? So this is the date I have selected here. Now this is not actually what I was looking for. Even you guys were probably not looking for, but I just told you, just to try to teach you. You see, all the Excel sheets has been edited at once to such an extent that the zoom in portion is 120 for all the sheets. Earlier it was only for the cash flow, now it is for all the sheets, it is just identical. So now let me do one thing. So what was our starting date for the business? Let us just look at it. What was the starting date? This company started its operations on 1st of April 2022. Then what I am doing with these dates? That is not relevant, so I am going to change it, no problem. 1st of April 2022 is going to be a starting date. So what I am doing? This is the starting date. So as per this, all dates have changed, right? But even this is also not what I am really looking for. So see, now all these sheets are ungrouped. So this results are still here, right? So I will group these things and just clear all those things at once. Now you can check, control page down, wherever you go. Now it is just doing fine. So now let us get serious right now. We will start working on it right now. So I'm pressing Control, As I showed you one demo model which is a replica of it, so I'm just going to make this thing only for all of you. Okay, this was our demo model, so we are just going to create this thing only. Okay, we will create this thing only. Let me now put the expected date. So what is going to be the year ending date for all of us? The year ending date, that is the business has started on 1st of April 2022. What is going to be the year ending date? So it is going to be, what it is going to be, 31st of March 2023. Why I have written this in this way? There is a reason. If you go and check the format, this is actually the correct format. March 31st 2023 it is showing. There is also some more things I need to teach you regarding the date formatting. I will teach you those things. So in the previous session also I told you guys regarding it, right? Now this is the date, the end of the first year's date I have put in here. Now press equal to end of month formula we will use here, EOM. So very shortly I just took you guys through this formula also in the second session of Excel towards the end, before the EMI calculation. End of month, press, I'm showing it to you once again, press equal to, type EOM, end of month, press tab, starting date, comma, number of months is going to be 12. So after 12 months from today's date, what is going to be the next date? It is going to be March 31st 2024. So we have 2 years data, 2 years date now, 3, 4, 5, Control R. We have got all the data, right? I would just like to even edit this data to make it more presentable. How I can do it is that, okay, I will use the shortcuts only. So Alt H, here you can see the H. Now I can change the colors. I can fill the cells with some color that I love, I like. So what color should I put in? I'm selecting this deep blue color. I'm making it bold, Control B. Again Alt H, font color, FC. I'm selecting the white color here and pressing enter. So now all those edits has been made to all these Excel sheets. PL, balance sheet, cash flows, assumption sheet, everything has been done. Now I do not like all these grid lines. So I would like to remove all these grid lines from all the sheets. Let us do it. Press Ctrl, group these sheets, press Alt, for view press W, VG for grid line remove. Achha, how to ungroup when you have grouped any this in number of, let's say, sheets? How to ungroup? You can just click on this sheets. See, it is getting ungrouped. So initially it was all selected like this. How to ungroup? Just click on any of the sheet and it will get ungrouped. Now check. So it has been done, right? So now in the assumption sheet I have something to build. So in the assumption sheet I will write down the date of commencement. Date of commencement I have written here. Then what I can write? The actual date of commencement. So in the B1 cell I am writing the date of commencement, that is April 1st 2022. Now this thing is getting hidden. I did Alt OCA to make it clearly visible to all of you. So now we will have a list of data here. Like this particular Excel sheet, we will have a list of data here, like this. A list of data we will have. List of data we will have. But see, what is the difference between this particular model? See, as I scrolled up and down, all these things are getting scrolled up by itself. If I slide this way, it is getting the same way it is getting hidden. I want my these particulars and this date to be fixed. Even I move at this direction or I go down, I want all these date levels and these particulars to be constant here, so that I can constantly look at it like this particular sheet. See how helpful it is? So I would like to do it like that. So I have already shared the shortcuts with all of you last day. You can see freeze pane. How to freeze pane is that freeze panes Alt W F F. I have already shared this shortcuts. So I will do the same thing. I will press Control because I want this change to take place everywhere in all the Excel sheets, and press Alt W for view, F for freezing, F for freeze pane. And now wherever I go, it would actually help me. Now throughout all the sheets, the same. Okay, for the freeze pane, probably it doesn't happen like that. So I will do it individually. Alt W. Okay, let me just try it once again. Then I can confirm. So I'm grouping these remaining sheets now. I'm going to group all these remaining sheets now and pressing Alt W F F. It has happened for the cash flow, but it hasn't happened for balance sheet and PL statement. So we will do it manually. Alt W F F. As it has not worked, so Alt W F F. Now it is ready for our use. The basic structure is ready for our use. PL, you can check the basic structure is ready. So now the date of commencement of the business is already given here. We would just like to make it bold. We wouldn't really be focusing on right now about the formatting part, and look wise we wouldn't really be concerned right now, because we are not focusing on the look of the model right now, but the linking of the model and how to build a model. Because after you get to know how to build a good quality model, a dynamic model, then all these things will be very easy for you. So it's okay. So now let us get back to our main question. This was our question. So EVS Private Limited started its operation. So yeah, before I start, I would just like to request you only one thing, is that please keep doing these things with me. I will be sharing this thing, this entire PDF with you, this question, this case study, and then entire Excel sheet. After solving it, definitely I will share with all of you guys, but I want you guys to do it with me. Don't keep it for later on कि हाँ ठीक है वीडियो अभी देख लेते हैं, बाद में ट्राई कर लेंगे, समझ में तो आ रहा है. It should not be like that. If you are doing it for the first time, know this particular thing is that, know this truth actually. I am just trying to make it like, over easy for you, so that it may look like a child stuff, but it is not. It is actually very difficult. I am just trying to make it like a child stuff, but it is not a child stuff. It is difficult. So please do it consciously and do it along with me. Do not miss on anything. If you miss on anything, rewind this video, watch it once again. So let's start now. So EVS Private Limited started its operations to manufacture product A on 1st April 2022 with an authorized capital of 20 lakh and number of shares are 2 lakh, and face value of these shares are going to be 10 rupees. So what we can do first is that we can write down in the assumption sheet the sources of fund. Sources of fund. So underline this thing, as this is going to be a major line item, you can just underline and make it bold. Now, what is being contributed to the company is the equity share capital, right? So write it down. Equity share, CAPITAL, yeah, equity share capital. So how much is going to be the equity share capital's amount? I am leaving this column intentionally because we will use this column later on. So I am just writing the amount of equity share capital, and all this kind of money inner, like any percentage, like the rate of interest on loan and all those things. I will write those informations in the Bth column itself, not in the Cth column, because we will be using this column in a different way. So in the B4 cell address, you can see in the name box. So in the B4, I'm writing the equity share capital, which is, what should be the amount of this equity share capital? It is 2 lakh multiplied by how much? 2 lakh multiplied by 10, right? But it is the total capital which was contributed by 4 promoters. All of them contributed 5 lakh rupees. Try to understand one thing. And number of shares was 25,000 only. So how can it happen when the face value is only 10 rupees? So if you just do it, 5 lakh divided by 25,000, what you will get if you are doing this thing? 5 lakh divided by 25,000, you will get the answer to be 20 rupees. But here it is written that the face value of the share is 10 rupees only. Then how come it is 20 rupees? I already said that it is this extra 10 rupees was paid as securities premium. So we will add one extra line item for securities premium. So how it would actually look like? 25,000 shares. 25,000 shares multiplied by 10 will make it 25,000, and 4 promoters are there. So yeah, 4 promoters multiplied by 25,000 shares each multiplied by 10 rupees is going to be 10 lakh. So I'm just in the equity share capital going to write down 10 lakh. Okay, let me do just one more formatting for you guys, which will be useful for all of you later on. I just realized that this thing will also be helpful, so I'm just doing this editing also. Press Ctrl, group all the sheets, press Alt H K for putting comma and for this counting thing, and I am pressing Alt H9 for reducing the decimal places. Now I did it for only one cell, but no, we need to do it for all the cells. Control Shift right, Control Shift down. For all the sheets, let's do it. Alt H K, counting, Alt H9 for reducing the decimal places. So if you now go to it, it is showing all customs in the same mode, right? So what I was saying, let me now prove it to you. Let's say I'm writing 10 lakh, press enter. See, these commas are happening. If you write it here, let's say 25 lakh, see, these commas are appearing. So for this benefit, I did this thing, and we have removed the decimal places also. So equity share capital, we have got it. What should be the next line item? Is that the securities premium. Securities premium of how much? Definitely 10 lakh. Why I have not edited these things? I can do it, no problem. Okay, one thing is that I forgot to ungroup this thing. So yeah, if this same thing happened to you, just go to the individual sheets and ungroup this thing. Actually, grouping is a really risky task. If you do it, you have to do it very much consciously. I'm just teaching, giving all the directions, and along with it I'm doing it. So yeah, I even forgot to ungroup the sheets. It's okay now. You can check. Control page down, control page down, control page down. It's all fine. So now I can definitely make this things also into comma if I want, because but I didn't do it. I didn't format it because there were some other issues, because we are actually going to put even percentages also, even that interest coverage ratio, those kind of things. So I haven't put the commas intentionally here, but it doesn't make that much of a difference. It actually doesn't make any difference. Now this company raised a debt, so equity part is done for our thing. Now this company also raised a debt of 15 lakh at the rate of 10% per annum, right? So let us now do it. Debt at the rate 10% per annum. How much? 15 lakh. It was given here, right everyone? Now total of this capital structure. How you can do it? Easily. Alt equal to, press enter, you have got your capital structure ready. Now here are few very important concepts which I have to discuss with all of you guys, which is very important. So I'm just doing one thing, Control B, highlighting these things, and also doing one thing, Alt H B. I am putting these things, Alt H B I did. For top border you can press P, so it would look like this. Okay, I am doing it only for this one, so that it is a bit more presentable. Now remember one thing, please do not miss on the cell references. As I have done it, I have started my work from this A1 cell, and as I have done it, accordingly you guys also do it. Don't do it like you start from, let's say, B2 cell. No, please don't do it. If you miss anything, if you make any mistake, otherwise you will not be able to rectify your mistake, and you will get puzzled, and you will think like, oh no, I am good for nothing. I'm good for nothing. So yeah, financial modeling is not a cup of my tea. But believe me, it is such an important skill. If you learn, your career is just going to shine. Believe me. So just do it as I'm doing right now. The time will come when you will be doing all these things by yourself, and this particular sheet, making this particular model will be a child's play. You can just do the entire thing within just 30 minutes. Roughly it will take only 30 minutes to do the entire work. It will become so easy after a certain point of time. Now we had this debt taken. Now there was some information shared here about the interest rate will jump to 12% in case interest coverage ratio falls below 8.5x. The management and the bank agreed into a contract where EVS Private Limited is exempted. So we have to just remember this thing right now, but we will be using this later. एकदम बाद में we will be using this 8.5x of interest coverage ratio, not right now. Even this 12% also. We will use this later on, not right now. Now let us look at the terms of loans. The terms of loans requires the company to repay minimum 20% of the outstanding debt at the start of the year, second year, right? At the start of second year. That means first year mein there is no loan repayment. Second year start, that is on 1st of April 2023, we have to make the payment. Our company has to make the payment. So here we were talking about so much about debt repayment, right? That means when we have to pay off the debt. So this information was given here regarding debt repayment. That is how soon, when we have to pay off the debt. So this thing was given here, right? So just a simple line I will add here. Debt repayment schedule. Debt repayment schedule. So it is like a calendar only. I have made just a calendar like thing I have made. अच्छा तो इस टाइम पे इतना पे करेंगे, इस टाइम पे इतना, इस टाइम पे इतना, just like that only, nothing else. What is now written here? Let us see. The terms of loan requires the company to repay minimum of 20% of the outstanding debt. जितना debt बाकी है उसका 20% पे करना है at the start of the year, starting from its second year of operations. इसमें एक catch है छोटा सा. So I will just do it and show it to you later. I'm just putting a hash here because there are some other informations also we have to refer to now for this thing. Okay, as of now, there is nothing more given here. So we will just wait for some more in-depth information. Let us till that point only, let us now move on to some other things. That is about the loan. So we will do one thing. Opening balance. So what is this opening balance? This is opening balance of the loan. Add loan taken during the year. Add loan taken during the year. So opening balance means opening balance of the loan, add loan taken during the year, less loan repaid, less loan repaid. Closing balance. I will just put some rough information here for now only. So for the opening balance of the loan at the beginning of the business day, what was the loan amount? It was actually 0. In the initial stage, it was 0. That means there was no opening balance of the loan. Yes, definitely we took loan. We took a loan during the year worth of rupees 15 lakh. Definitely we took this loan. But there was no opening balance, right? Opening balance means what? You had some closing balance which you have carried forward. We didn't have such element. So opening balance is 0. Loan taken during the year is 15 lakh. Loan repaid in the first year was 0. Closing balance was again 15 lakh. Now, how to calculate this closing balance is that you had some opening balance plus you took some loan minus you have repaid some loan. This is actually the closing balance. Now, this closing balance, what should happen with this closing balance is that it gets moved forward to the next year. So this was the opening balance part. loan taken during the year, it was 0. So no loan was taken during the year. Now loan repayment amount we still do not know, right? So till this point I'm dragging it because there was no loan taken during any of the next years. Now this is the closing balance. Now debt repayment schedule, we have to work on it. So let us now have to work on this thing. So let us move on to this thing about the loan repayment schedule, that is how the loan was repaid. So now about the debt part, debt repayment schedule. So you have to read this line very carefully. Debt repayment at 30% in year 3 and 4 and 35% in year 5. Year 4 and year 3 and 4, so and in year 5. So this is the condition given here. So first year there is no repayment, second year there is a repayment, third year and fourth year and fifth year the repayments are given here, right everyone? So we can get those things here. So that means what is happening here, it is happening that in the first year there is no repayment. Second year we are paying 20%. Third and fourth year is given here, which is 30%, and fifth year is given here, which is 35%. So now let us put this information here. So debt repayment schedule in the first year end, that is after the end of first 1 year, the repayment has been 0%. Here it is 0%. Here it is 20%, 20 or 25. I have to check. I think it was 25%, right? No, minimum repayment of minimum 20% of the outstanding debt starting from this. So yeah, this is going to be 20%. Achha, now we were seeing that this is just 0 and 0.2 and this is 0, right? So how to change this? Control shift percentage. If you do, it will appear as the percentage. Now what was the third year's payment schedule? As per the third and fourth year, it is supposed to be 30%. 30%, same 30%. You can manually punch this thing, and in the last year it is going to be 35%. So all these things are showing in 0, control shift right arrow, control shift percentage. If you press, it will appear like this. There is also another shortcut for this, Alt H. You can see percentage P, Alt HP, you can make it into the percentage. Now look at it. Look at it very carefully, because this is the debt repayment schedule we are preparing, and this is one of the most important thing in your assumption sheet. Okay, so this is the opening balance we have got from where? From the closing balance of the first year ended, right? So now this year we will pay off the loan. You might be thinking, okay, this was the starting year, right? So this year started here, but this year ended here, right? So this thing is as of whatever activities took place in the first year. Those data we are recording here, right, in the D8th column, and for the E8th column we are recording the informations, the transactions that would take place between year end 1 and year end 2. That is दूसरे साल में जो कुछ भी होगा हम लोग उसको यहीं पे रिकॉर्ड करेंगे. That is the thing. Now loan repaid, how much of the amount should be repaid? It should be equal to, now it should be equal to this amount, that is the outstanding amount, इसका what, इसका 20% should be the repayment, that is this amount, right? And what should be the closing balance? We did the calculation for closing balance, which was opening loan balance plus any loan taken during the year minus the loan repaid was the closing balance. So I am just doing shift right arrow key and Control R for copying this formula and pasting it towards right direction. Now for the opening balance of debt, we linked this with this one because the closing balance of previous year was going to be opening balance for the next year. So we can just copy write this formula. It is showing in hash, so Alt O C A to adjust the width of the particular cell. Now loan repaid in this particular year. So we did this calculation. So we can just copy write this formula because it is going to be how I calculated it. It was the opening balance multiplied by the given percentage. So if you just shift right arrow control R, if you do it, so this is how it will work. Now if you are thinking is this calculation right or wrong, you can do it just manually and you can check that definitely it is right. So this is how we have created a small debt repayment schedule. Now you might be thinking that where is the interest component? So interest component still we haven't included here because we are going to make a different schedule for the interest part. This is only the principal part we have only taken care of as of now. Nothing more, nothing less. So right now, after we have taken care of the debt part, now what is the remaining part in the debt is the interest on that debt, that is interest on loan. So interest, we're writing here in the 16th row, 8th column, interest. You can just make it bold. Then here you have two cases here. What are those two cases? So in the first case, you have one particular case here. And in the second case, that is case B, you have another case here. Where are those cases? Those cases where if your interest coverage ratio comes below 8.5x, then a different interest rate. If it stays above, then a different interest rate. Let us look at it now. Yeah. So loan raised of 15 lakh at 10% per annum from HDFC Bank, the interest rate will jump to 12% in case the interest coverage ratio falls below this 8.5x. So now we have these two different cases, two different rates, 10% and 12%. 10% and 12%. So these are the two cases we have. Now, if you just look at it, that these are the two scenarios given to us. Now what to do on it? So the answer is very simple. We will calculate two interest amounts here using these two different rates. So we are just doing it equal to closing balance multiplied by this rate, and we are fixing this rate because this rate will remain constant, but we want that our calculation, as we copy this formula and paste it rightwards, so this selection of cell should move on towards the right. And there is one more thing, this rate is constant, but if we would like to do the calculation at once, what we can do is that we can fix this cell in a manner so that it wouldn't shift rightwards or leftwards, it would just go up and down. So that means B is the column. So if we fix the column, press enter, and if we copy it, shift it rightwards, shift down, control V, then okay, there is some issues happening most probably. Let me check it. Why there is okay? So we haven't. So yeah, we should have even fixed this column part, this row part, which is 14. So we are fixing the row part also. What has been done? Let me show you once again. Okay. So we had this closing balance, right? The closing balance amount, you can see what is the closing balance amount. It is the 15 lakh and the next year it is becoming different, different and different. So we would like to put a formula in such a way that as we use this formula, which is actually this, and if we paste it rightwards, the entire formula should automatically get calculated towards the right, and if we paste it downwards also, it should get to work like that. तो इसमें क्या करना चाहिए, हमें इस 14th रो आपको दिख रहा है, तो ये 14th रो में साइड वाइज मूव करेगा, राइट, एंड यहाँ पे रेड कॉलम वाइज अप डाउन मूव करेगा. So we can fix the column by fixing this B, which is the column, and for the row part of this thing, मतलब ये ऊपर नीचे नहीं होना चाहिए, right? So ऊपर नीचे नहीं होना चाहिए. So what we can do is that in this D4, 14, we can fix this 14th row. So we are just going to fix this 14th row. Press enter, Control C, copy, shift rightwards, shift downwards, Control V, paste. Now you just check this formula. Every time you are doing it, check the formula. Press F2, see the color. The selection of the data are correct. This multiplied by 12%, this 12 lakh multiplied by 12%. So this calculation is absolutely correct. This multiplied by 12%, this multiplied by 10%, it is correct. So interest we are now done with the interest part. Now we will add one particular thing, although we won't be able to work on it right now, but still we will do it. So what is this? Interest coverage ratio. We won't be working on it right at this moment because we are still not done with the calculation of EBIT, which we are supposed to calculate in the profit and loss statement. So we are just leaving it for now. Then when we are done with all the things related to equity and debt, let us now move on to some other thing right now. So we are done with this, all this debt equity wala part. Interest coverage ratio, as I said, we will be able to work on it only when we are done with what? When we are done with the EBIT calculation, EBIT calculation. So now let us look at what is the next thing in our case. So it is for manufacturing product A, EV's Private Limited spent 25 lakhs for buying 2 machines on the second day of the year 2022. That is not on 2nd of January, but it is on 2nd of April. So our fixed asset which we have purchased is of this amount. So what we can do is that we can now make one fixed asset schedule. Fixed asset schedule. Highlight it, make it bold, Control B. Then in the fixed asset schedule, what are the things that should be there? So it's the capex, that is the capital expenditure. Why I am writing it as capex? Because this is a capital expenditure this company has done. Right, this is a capital expenditure and not a revenue expenditure. What is the difference? That means capital expenditure means you have invested in some plant or machineries, so those assets are going to provide you some economic benefits over the period, which is more than 1 year. So that is the capital expenditure. Or revenue expenditure means the expenses that you incur, which will give you the economic benefits for a period less than 1 year. So these are the two things, differences between capital expenditure and revenue expenditure. In short form, we can call capital expenditure as capex. Now let us look at it. So the capex part, in the first year, what was the capex amount? First year we made an initial capex of 25 lakh. So 25 lakh is our initial capex. Then in the next year, we did some more capex. So this was bought two machines. On the second day of the year 2022, the yearly capex is estimated to be how much? 2 lakh for second and third year. So this was the initial first year's capex. Second year and third year we made a capex of 2 lakh. So we can simply write it down. 2 lakh capex, 2 lakh rupees of capex. Then what is there is that fourth year and fifth year capex is amounting to be 2,20,000 rupees. So 2,20,000 rupees of capex has been made. So this is under the fixed asset schedule, we have just written down what were those capex. Now, one thing that may come to your mind that this capex were made. So, weren't there any depreciation? Depreciation का क्या हुआ फिर? कैपेक्स तो कर दिए, ये समझ में आ रहा है कि हम लोगों ने कैपेक्स किए है, बट depreciation का क्या था? Depreciation का एक rate was given already. Depreciation is chargeable at the rate 12% of the yearly written down value. Depreciation 12%. We will be working on it later on, not right at this moment. Okay, we have something to do with this depreciation rate while we will be working on profit and loss statement as well as the balance sheet, some of the balance sheet parts as well as on the cash flow part. So right now we are not doing anything with the depreciation part because we have to do a lot of work with this. So now after the depreciation is done, then we are doing opening balance of what? Plants and machineries, that is our fixed assets. So in the very beginning of the year there was no fixed asset, so there was no opening balance. As I told you about the debt schedule, there was no opening assets. Then we did some purchase because this is a newly found business, so we didn't have any opening balance, but then we did some purchase. We purchased some assets. 25 lakh rupees of assets we purchased. Then what did we do? Less sales. So did we dispose or sold off any of our fixed assets? So less sales. Did we sell off any of our assets? The answer is no in the first year, so we have made it 0. Now this is the part called as gross block in technical terms. So gross blocks, it is without adjusting the depreciation. So when we actually adjust the depreciation part, or we can call it as accumulated depreciation part, after adjustment of accumulated depreciation along with this gross block part, then only we can come up with a net block which will be reflected on our balance sheet. And net block is always post all the disposals and the depreciation. So now let us look at the gross block part, which is supposed to be opening balance plus purchases minus closing balance. That is, minus sales. Opening balance plus purchase minus sales. That is any disposal. So we can copy that, Control R, this formula. Then opening balance for the next year is going to be equal to, this is going to be our opening balance. Press enter. Now add purchases. So did we have any purchases made in this year? So definitely there was. So we can just link it to this new capex. and we can just simply copy it, right, pressing Ctrl R. Now sales, was there any sales made during all these years? The answer is no. We didn't find any information regarding any asset disposal, so we can simply ignore it. Now this was the opening balance, so if we just simply copy it and paste it, right, it is correct. You can check it, and in the very initial stage when you were just learning this kind of things, make sure you always check and recheck your figures. So this is the gross block part we have come up with. The next part is something to do with the accumulated depreciation. So now you think how and on what amount you should be charging the accumulated depreciation. I'm giving you some time. Just think about it. On what amount you should be charging the depreciation. So now, as this is the gross block, if we deduct less accumulated depreciation, if we just deduct this accumulated depreciation from this gross block figure, then what do we get? We get the net block, that is net assets. So how to calculate this depreciation? So one thing we could have done is that we could have simply just deducted this 12% of depreciation, which is 12% of the depreciation. This is the depreciation rate chargeable, you can see. We could have just simply done one thing, that we could have deducted this 12% from this, and we could have come up with the depreciation amount. Like that we could have done it, but this is a more better and scientific and easy to use way. The benefit of it, you will be realizing it later on, but yeah, definitely you can come up with your own method as well, but not today, probably sometime later on. So how to calculate the accumulated depreciation? So press equal to gross block multiplied by the depreciation rate is given here. I am fixing this rate because I do not want this rate cell to move here and there, and if I press enter I will get it, but it won't be correct. There is a reason. So this is roughly a rough calculation of the depreciation, right? Now I do not know whether you remember it or not, but here we said that for manufacturing product A, EVS Limited spent 25 lakh for buying two machines on the second day of the year 2022. So we should have calculated it on a proportionate basis, right? So what should we do? This is the accumulated depreciation for the entire year. So what we can do is we can just put it in a bracket, and what we can do is that we can multiply it by 364 divided by 365. So you will get it. So you will get the depreciation for the rest 364 days, because you bought this asset on the second day. Where is the information? Yes, second day of the year. So second day means first day you didn't use this thing, but from the second day you were using it. So press enter. This is your depreciation amount, and we are transferring this depreciation amount to your accumulated depreciation account. So here also I can put the same result here, but I will do it later on. Now accumulated depreciation for this amount. What should it be? Just think about it. I am giving you some time to think about it. You just think about it, then come up with a formula. Try to do it by yourself first. The gross block amount has gone up, you can see it. So the answer, I think you have found it out. If not, you have been able to put it on Excel, but it's okay. If you have somehow figured it out. So how it should be is that you have this thing. You have the gross block amount given here, which is the sum total of this opening balance plus the new capex or purchases. But you had this accumulated depreciation on this 25 lakh, so which is included in this amount. So what you can deduct is that, what you can do is that accumulated depreciation, gross block minus accumulated depreciation, which is now actually your balance of assets, multiplied by 12% putting it in another bracket plus this amount, and I am getting this amount. So now you try to judge it by yourself. You can do it with a calculator also if you want, side by side. So what did I just do? Simply just look at it. What did I do here? I did a very simple thing. What did I do here is simply, I'm doing it once again for all of you. What I did was, I took this entire gross block amount, that is the total asset amount minus previous year's depreciation. I am eliminating it. Then it becomes the asset balance of today. Close the bracket. Then I am charging a depreciation of 12% of on this asset balance. Then I am closing the bracket. Then I am closing this bracket, and I am adding this accumulated depreciation amount with this, and I am getting this one. Probably you are still confused with the calculation thing, so let me show you now with the help of the only depreciation account. Then I will show you the accumulated depreciation part once again. Probably I think that way it would be like much more understandable for all of you. So how I am calculating the basic depreciation is that equal to, I am just taking the gross block, multiplying it by 12%. I am even fixing it because I need this 12%, 100% fixed, multiplied by 364 for the first year, divided by 365. So that was my depreciation amount. It is matching. Now for the second year's depreciation, what should I do? For the second year's depreciation, see, if this is the first year's depreciation, I am telling just this thing. this one, which is 25 lakh, was your net asset value. Minus you had depreciation of this year. Minus you had depreciation of this. So this was your depreciation. Then what should have been your remaining amount? It should have been your remaining amount in the asset account as of the end of first year. So on your balance sheet, what amount should come? This amount should come at the end of this year. Now what I am doing is that this is one. Here I am writing it for your convenience. Then in the second year, okay, 1 year end. Let me write 1 year end. I am writing it for you. Now what we did here is that we just purchased another asset. So what did we do? We purchased asset. Now what is the total of this? Equal to this plus this. This is the sum total. I charge depreciation amount here. So this is the total. Now this is the total gross block. Block means assets. So total gross block is this amount, correct? Now what I am doing, I am charging a depreciation on this amount only, equal to this amount multiplied by, if you just do 12%, you are getting this amount, you are not getting this amount, right? So now if you add this depreciation and this depreciation, what you will get? So this was the depreciation amount. Let me write it down for your convenience. Let me do it like that. It is the same thing I am doing. Nothing new I am doing. I am just doing it for your convenience. Yeah. So the same thing has come, right? What I just did, depreciation was in minus. I just made it sign neutral and just did purchase value of the asset, gross value of the asset minus depreciation I did first year and then purchase. So this is the gross amount. You can see first year plus purchase, first year end plus purchase. So this was your total gross. Then gross block, you can see here and here also total gross block. I charged a simple depreciation amount on what? On this total gross block multiplied by this 12%. I got the depreciation. Now what should be the net asset value? This minus this one. Now we were thinking about this accumulated depreciation. Accumulated depreciation means you are accumulating the depreciation. So what should have been your accumulated depreciation at the end of second year? It should have been this, which is actually this, and I have put in the same formula here. So for your convenience, if you want, I am writing it down once again, the depreciation formula. So what did I do here? I just simply put a percentage on it. So this time I won't be able to do it. So what I have to do? I have to do this minus this one, this minus this one is the net figure now, as we did here. So this 2 lakh has been taken care of in the 27 lakh. Now what I can do is multiplied by 12% fix. You keep this figure with you. See, the depreciation amount is matching. So we can just drag this formula and we can get the depreciations, right? We can get the depreciations easily. Now what about this accumulated depreciation? It is nothing but simply just this. You can just drag this formula also, it will work. Otherwise you can differently calculate it, but there is no point of it. Did anything change? Definitely it has to change, right? What did I do? I just simply copied and dragged the formula. So ultimately this is becoming my accumulated depreciation accounts value. So if you calculate it like this, making a schedule, you will arrive at this and this value itself. If you want, you can try it. Pause the video and you can try it. If you have not understood it, you can just do it by yourself. You can just pause it and you can do it. So accumulated depreciation, now what should be the net block? What should be the net block? The net block, that is the net asset, should be equal to opening minus this accumulated depreciation. This one should be the accumulated this should be the net block amount, and as this gross block has taken care of this capex and everything, so we can simply do control R. So this will be our net block amount. You can check it. Net block. Now we will be going forward with another thing now. The next thing which is there. So the next thing is we have to check it here. EVS private limited. So we are like quite done with the this fixed asset schedule. Now let us look at this. EVS private limited is expecting to achieve a capacity utilization ratio of 60%, while 75% of the available goods are expected to be sold. So now this is about the capacity utilization. So let us do it. So first year it is going to be 60%. Capacity utilization is going to be 60%. And here are the other total capacity utilization percentages are given here. 60, 62, 64, 65, 66 for the 5 years. Let us make a schedule on it. Capacity utilization. What was the first year's capacity utilization numbers? 60%, 62%, 64, 65%, and 66%. Now it is showing in 1, you know what to do, right? Do it yourself. What to do? Control Shift % or Alt HP, Alt HP, it is done. Capacity utilization. Now the total capacity in units, we should also write it down, right? So we will write it down. Total capacity in units, we have write it down. What was the total capacity? 1 lakh units, right? If you remember. Yeah, production capacity of 1 lakh units. Now then, what would have been our total production? How much we would have actually produced? So total production, we can just simply do one thing. The capacity utilization is given here, so we can simply consider this 1 lakh multiplied by this rate, and we can do the calculation. But if we just fix this 1 lakh part, then it would be very much easy, right? You can just press enter, utilization is given here, control R. You have got the results. Total production in units. Now the next thing, what is the next thing? Look at it. So production we have taken care of. Now, what is the next thing? While 75% of the available goods are expected to be sold in year 2022-23. So how much is supposed to get sold is 75%. So if this is the story, that 75% of the production will get sold. See, the schedule is given here, when the percentages are given here, right? First is 75, 76, second 77, 79, 82. 5 years percentages are given here. So we can write down one thing like sales as a percentage of total goods, like that you can write it. Means what I'm trying to say is that this is our total capacity to produce 1 lakh units. So in first year we could produce only 60%. So we produced actually 60,000 units, but out of that 60,000 units, how much we were actually able to sell is 75%. That is 45,000 units. Right, 75% we were able to actually sell. So we are just putting the same thing here. Okay, so sales as a percentage of total goods. Sales as a percentage of total goods. What was the percentage of first year? 75%, second year was 76, 77, 76%, 77%, then it was 79%, and it was 82%. Now again, convert it into the percentage. You know how to do it. Alt HP or Control Shift percentage, whatever the way you like. Now we can, from this thing, what we can do, we have few things to do. If we want, we can do it right now itself or even later on. What are those two things? Is that we can calculate the inventory amount right now, or we can even do it later on. I think I should be doing it after some time. You can, when you will become a pro in this, so then you can do it whenever you want. I'm going to do it after just few lines, after just few items. And why this is so? Because I think that way it would be helpful for you guys to learn. Now we are completely done with this point. Now this percentages, we are done with it, but we are still left with these things, this percentage, that is selling prices this much, expected to grow this much, this. Okay, let us just go up. The capacity utilization part is taken care of. Till this point it is taken care of. So the inventory part we have not calculated right yet, so we will calculate it after some time. EVS Private Limited is selling all the goods through commission agency, which will be paid 8% of the selling price for each unit sold. The yearly indirect expenses, okay, this is a different thing. So first let us deal with this commission part. Let us deal with this commission part first. commission, sales commission 8%. I'm just keeping it here. Now let me do one more line item, one or two more line items. Let me just do it first. That is, now what was the another thing was, I have put these things, I have considered this thing there. Now the next thing is the SG&A expenses, that is selling, general and administrative expenses, which is the indirect expense given here. So the yearly indirect expenses, rent, salaries, office expenses, etc., are estimated to be INR 12,60,000. There was some growth rate also, I think, attached with it. Let me check. Yeah. So yeah, SG&A to grow at 15% for second and third year and 14% for fourth and fifth year. SG&A expenses percentage growth. And what was the percentage growth? First year it was 0, second year, third year 15%, then 14%, then 14%. These are all year on year growth. And SG&A expenses so what should it be? In the first year it was 12,60,000, right? Yeah, this amount 12,60,000 it was. Next year what it would have become is that this plus this percentage, equal to this thing, okay, is it for this reason it is not working? Let me check. Oh, okay, yeah. So yeah, this way it wouldn't work. So like this into 1 plus this percentage, if I do, it will work then. Yes. So what did I do is that for SG&A expenses, I took this amount, that is SG&A expenses, I multiplied it with 1 plus 15%, and I got the result, which is actually the main formula, right? So if you just like decode this part as I taught you, shift F9 if you press. Okay, it is not showing the decodation, but it is one. It is like, as we used to do, like it is what has actually happened is that equal to 12,60,000 into 115 divided by 100. So this is what has actually happened here. So for doing this, we did this. Okay, I'm showing it once again. Okay, if you have not understood, I'm just doing it once again. I have actually showed this formula earlier to all of you. So equal to SG&A expense, that is last year previous year expenses, multiplied by first bracket 1 plus, why plus? Because it is growing, right? Press enter, you got the result. So if you just drag this formula, it will go all the way and give you the right result. SG&A expenses. Now let me see what is left here. Okay, so the goods are sold on credit and the company is expecting to recover the receipts from the debtors in 40 days in the initial year. So the goods are sold on credit, that is this our company our company EVS Private Limited, they sell their goods to the customers on credit and the company is expecting to recover its receipts from debtors in 40 days in the initial year, which gradually is expected to come down to 30 by 5th year of the operations. So let's do something. Is there any additional information given here? Raw materials, creditor days? No. So let us just do it. So debtor days. Debtor days. So first the debtor days were, it was 40 days. 40 days and it's supposed to become how much? 30 days by the end of 5th year. So in between it will change. How it will change, we have to figure it out. There is no given percentages given here like this. Nothing is defined like this, nothing well defined is given here. So we are just taking some assumptions. So 40 to 30, we in between we have 3 years. So we can 40, we have this 9 gaps, 40 to 30, actually 10 gaps. We divide it in 3 parts. So we can do it like, let's say, we are just making it up. Okay, there is no data given, so I'm just somehow trying to make it up. So I can take it in points. I can divide this, the differences between 30 and 40, that is 31, 32, 33, 34, 35, 36, 37, 38, 39, and then there is 40. So in between this 9 numbers, I can just distribute it equally like 333 also, or I can take the difference as 10 and do it like 3.33 also. But I am simply just doing it like this. Let me see what could be the result till the end. So it has become 31. So now if you do not like the distribution like this, you can make it as per you, because there is nothing given here, no data is given here. So it is as you think. Now it is like a bit of outlier. It is deviating too much. You can make it like 38, then let's say 35. It actually a bit looks better, because there is in between there is 3's gap. Or if you take it like 37.5, probably it would look even better. So if you just put it in 35, then 32.5, I think it is more like evenly distributed. It is evenly distributed. So yeah, I can keep this thing also, no problem. And again, I am not doing anything with this anymore. So as some more information we gain, we will work on those things. So now data days, it is over. We are done with this thing now. On the other hand, EVS Private Limited takes about 60 days to make payment to creditors from whom raw material is purchased to manufacture products. So EVS Private Limited has plans to give dividends to shareholders at 25% in any year. Okay, that is a different thing. So yeah, 60 days. Any additional information, is it there? Let us check. Yeah, about the creditors there is something given. Achha, we are done with this thing. done with the debt repayment. Okay. Here we are done with the sales part, the selling price, and this growth is not done, this is not done. Okay. So creditors days to come down to 55 in the year 4 and 50 in the year 5. So it is currently at 60. Yes, it is currently at 60. So creditors, creditor days or creditors, you can make it up to you. We have only one creditor, so your creditor days. Then it was 60 days, 60 days, 60 days. Then it became 55 days, right? In the fourth year, it has become 55 days, and it has become then 50 days, as it is given here. So creditor days we have listed it down. Now some other, like this kind of credit things, we just saw it once. So this one was outstanding expenses account for 1.25 months. Outstanding expenses, it is in months. So this can be some small expenses also. Outstanding expenses accounts for 1.25 months. Outstanding expenses days bracket in months. So it is 1.25. 1.25 odd H0 odd H0. So equal to this, then you can just drag it alt H0 alt H0. Outstanding expenses days in months, we have just got this data now. Now, is there any more information left? The tax rate is left. I will be using this in the income statement. Let's check here. Plans to give dividends to the shareholders at 25% in any year when net margin is above 10%. So EVS Private Limited, this company is planning to give dividends to the shareholders at the rate of 25% in any year when the net margin is above 10%. Just list it down. Dividend if net margin is greater than 10%, and how much is the dividend percentages? It is 25%. Okay. Now, have we missed any other informations? So this paragraph part, this textual part is over. Now the raw material part, sales part, so which is actually the part of the income statement, but we will be doing the calculations here itself. So here also we can do the calculations related to the sales price. What are the things? Sales price is there, then raw material and labor is left. So the direct part is still left. The direct expenses part and sales is still left. Okay, we can do it in one place. We can do it in one place. total production, sales, so percentage of total goods, sales commission. When we are discussing about the sales commission, I think I guess we can do it here also. Why not? We can do it here. Okay, so I'm just listing it down here. Okay, so sales, I'm just listing it down here only. So the sales price growth rate, how much was the sales price growing? Price was 150. This is a constant price, like the base price, expected to grow at 7%. Sales price, so yeah, as this is the assumption sheet, so sales price growth rate, how much is the growth rate? It is expected to grow 7%. 7%. And what was the base price? 150, right? 150. We can make it like normal, 150. Okay, these were all in percentages, I guess. Yeah, so 150. Then next year, what it should have been? It should have been 150 into 1 plus 7%. And the same thing should have continued. Okay, one mistake I did. I didn't link it properly, so I should have just fixed this thing, which is this one. Then also it is not working. Oh, okay. Okay, I am also making mistakes. I should have fixed even the percentage part. Now it will do well. Control R. Why it is not? Okay, 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 okay. I got it. I got it. I got it. As it moves rightward, it should be taking this data. It should take this data. Then why didn't it work? 160. As I am moving rightwards, it is becoming this. It is becoming this. Yeah, what's wrong? It's correct. Let me just check it. Yes, 7%. Correct. The formula is also correct. Yeah, yes, it is correct. So what I can do is that I can just reduce the decimal places by using some Alt H 9, but it will take many times, so just manually doing it. So sales price growth rate has been taken care of. Now the raw material part we can take care of right here, because this was just beneath this thing. Raw material costs INR 60 per unit, and labor expenses 27 per unit is given here, and the expected growth rates are given here, which is to be 5% and 11% given here, right? So the raw material costs, so we can make the assumption sheet for the raw materials cost. Raw materials, it has a particular growth rate which is supposed to be 5% raw materials, and then the next thing is labor expenses. Labor expenses, and the labor expenses, it should grow at a percentage of 11% definitely. So now what was the base price? That is the 60, and it is supposed to be 27. It is supposed to be 27 years. So the raw material cost, I have taken it down. It is 60, as you can see, and the labor expenses is the 27. per unit given here, right? So now how to grow it? Just the same formula what I put in here, you can just copy it down. But yeah, I'm just doing the calculation once again. 60 I have taken multiplied by first bracket. I'm taking into consideration 5%. Sorry, yeah, so it should be 1 plus 5%. Now I should fix this entire cell, close the bracket, press enter, and just simply copy it, right? And for this thing, like I can just control D and the job is done. I can reduce the decimal places and I can just keep just one decimal place for it. Control S. While you are working on Excel, please keep doing this Control S and keep saving the files. So the raw materials and labor part has been taken care of. Now the taxation part, which was mentioned just here, just one part we missed. So the selling part has already been taken care of and the raw material part is taken care of along with the labor expenses. So the remaining thing is only the taxation part, which is to be 30%. So taxation part, it is the tax part. You can just check it. Taxations, it is flat 30% on profit before tax. You guys already know it. So I'm not giving anything because this is a fixed assumption given here. So there is nothing to calculate here. So is there now anything left? Think about it. Is there anything left for us to do in the assumption sheet? I told you one thing right here while we were working with this production units, right? So actually we should be working on this quantity produced thing. I'm just selecting this thing, removing a couple of rows, and in this area of total production I am going to do some work. I need to do some work. And what's that? So we had the total production, but we didn't have any clue regarding the inventories, right? So which is a really essential part of the balance sheet, as well as to some extent it also, not to some extent, definitely it impacts even the profit and loss statement also, and it even impacts the cash flow statement in the cash flow from operations, changes in working capital, that part, right? So total production in units we have already given it here. If you just do add opening stock was 0 in the first year. If you then what do you get is the total quantity available for sale. Total quantity available for sale. You were getting this thing. So how to get it is that equal to you add the total production plus the opening stock. So if you now deduct the sales portion less sales, if you deduct the sales quantity from this thing, then what do you get? If you deduct the sales portion, then you get the closing stock. You get the closing stock. So now, what was the sales quantity? Sales quantity is supposed to be sales as a percentage of total goods. So this is 75% of this thing, the quantity produced. Let me just check this conditions once again so that I can tell you with 100% assurance. Okay, EVS Private Limited is expected to achieve a capacity utilization of 60% while 75% of the available goods are expected to be sold. It is available goods, not the quantity produced. So the available goods, we have to calculate the sales amount on 75% of the available goods to be sold. So sales equal to this multiplied by 75%. Okay, manually there is not required because we have the 75% given here. So this was the sales amount. Then what should be the closing stock? What should be the closing stock? Equal to, you have the total quantity available for sale minus the sales, that is the closing stock. You can just copy right because there won't be any changes right at this moment. Now the opening stock is definitely going to be what? The closing stock of previous period is going to be the opening stock of this current period. You can see it, right? So now total quantity available, I can copyright, and as I copyright, so the sales amount which I incurred here, I can also copy it right. So if you just go here and check it, the sales quantity is clearly given here. You can check it, and the closing stock also you can check it. Available quantity you can definitely check it. Opening stock you can check it. So now I think we are done with the assumption part. We are just done with the assumption part. Now what we can do is that we can start now working on the profit and loss statement. So before we just dive into it, I would just like to make it a bit presentable. So closing balances of the loan taken, I'm just doing shift space control B or OCA. OCA. Then going down, gross block, net block, shift space control B or OCA. Then total production control B, closing stock control B, sales control B. This is also an important thing. So yeah, these were just a few assumptions that we have taken. Now we can start working on it. So now we can start working on it. We can start working on the profit and loss statement. So one by one we will be building all the statements. So now this is the time when we start building the profit and loss statement. So here we won't be following that structure what we generally follow, like revenue from operations, other income, that means total income, then raw material expenses, like that we won't be doing that, like employee compensation expenses. So as it is done in the annual report, we are not going to do it like that, because here we need some elements of like COGS, that is COGS, cost of goods sold. So we will be following that format where we made it like sales less cost of goods sold, then raw materials under the cost of goods sold, then raw materials, then labors, then like that we are actually going to do it. Then we will calculate the production cost, then add less the the stock portions, then we will come up with the COGS, then minus it, then we will come up with the gross profit. So like that old school structure we are going to do it. Why this is so? Because that will help you to understand the flow of it. So like the direct expenses will be taken care of at once, then the indirect expenses will be taken care of at once, then we will come to EBITDA, less depreciation, amortization, like that we will go forward with it. Okay, so this is for the better, easy understanding of it, so that you understand even the items like COGS and EBITDAs very clearly and distinctively. So this is why this method we are following. Otherwise we should have just we could have just gone with the actual format, but we will go through the actual format definitely. But yeah, this is for the easy understanding, we are going through it. We are following this structure. So sales, what was the sales amount? So if you just, now how to do it? Sales you have written down. Now there was no sales amount calculated in the assumption sheet, but we just calculated the unit, right? But we did have the prices. So what can I do? I can press equal to control pager. Then look for the informations related to sales. Sales quantities are given here. So we can take these quantities and we can take the sales price. So these are the sales quantities multiplied by the selling price, which we calculated on our assumption sheet. Press enter, shift right arrow, control R. If the width of the cell is not okay, then alt O, CA, you can see the figures. So the sales, we have got the sales figure. Now less COGS, less cost of goods sold. Now under this line item, cost of goods sold, what are the things that comes is the raw materials. It's the time for raw materials. So raw materials, how to get the raw materials? We definitely calculated about the raw material part. We had a discussion there in the assumption sheet. We did something here, somewhere here, raw materials. So raw materials, this is per unit, right? So tell me one thing, what raw material should be a part of it? Is it the entire amount or the amount of sales we made? It's the selling part, right? So about the raw material, what we are going to do is that we have to consider. So for the raw material part, what to do? We can do it equal to control page up. Now the raw material prices, we have already calculated those prices. The price is 60 rupees for the raw material multiplied by total production. Total production units. So number of units produced multiplied by raw material prices per unit. मतलब what I am trying to say is that जितना मैंने प्रोड्यूस किया है, if you just go back and check it, D48, D38 is that this is the raw material price per unit. मतलब एक यूनिट बनाने में प्रोडक्ट 60 रुपीज़ का रॉ मटेरियल लगेगा. सो दिस मल्टीप्लाइड बाई जितना प्रोडक्शन हम लोगों ने प्रोड्यूस किया है 60,000 यूनिट्स. सो वी आर मल्टीप्लाइंग दिस टू थिंग्स. नेक्स्ट टाइम व्हाट इट वुड बी 63 मल्टीप्लाइड बाई 62 So we can just drag this formula. It is dragged. Now after raw material there is labor. For the labor part, labor expenses multiplied by production, because it was also like per unit labor cost, so equal to, what you can do is labor expenses per unit multiplied by total production. I think you are understanding, right, why I have taken raw material as like this. Raw materials per unit multiplied by why production I have taken, because how much I have produced. This is in actual basis, right? So whatever I have produced, that entire thing I am putting it in the profit and loss statement. So now raw material labor is taken care of. Now this is the total production cost. So this is the total production cost. Alt equals enter, shift right, control R. Total production cost, you have got it. Now we had some opening stocks and closing stock. We have to now adjust the opening stock and closing stock. So add opening stock less closing stock. Now opening stock, what should it be? It should be opening stock, this one. Add opening stock less, what should be? It should be closing stock. Closing stock. Why I am adding and subtracting this thing? Control R. This is quantity. Okay, this is just the quantity part, not the value of it. So now tell me how to value these things. You have to multiply it by the production cost per unit, so you can calculate it. But in the assumption sheet, did we calculate the production cost per unit? You can check. Have we calculated the production cost per unit? The answer is no. So what we can do is that this is the production cost. We can see, we can calculate the production cost per unit. Like how we can do it? We can simply do it by dividing it by the, we can divide it by the units produced. We can just do it by that. So if you would like to adjust the opening stock and closing stock against it, what should you do? You should adjust the prices. So like for this thing, this is the assumption we have taken for opening stock. Now in order to get the value of it, this opening stock contains the price of this thing, right? And now what actually the inventory methodology was used, whether it is LIFO or FIFO, where if we assume that this methodology was, let's say, last in and first out method, then we can simply calculate the value of this closing stock by taking into consideration this production cost very easily, right? So if you would like to calculate it, how to do it, then what was the actual production unit? what was the actually amount of production was 60,000, right? So it was actually 60,000. So if you just do it like this, divided by 60,000 multiplied by, if you do this, which is actually the total production cost, you can get the actual closing stock. And for the opening stock part, so this will be the opening stock, no doubt. But what about this closing stock? Then this closing stock would contain the value of this thing. Now, how much quantity was produced in this particular year, we have to check, and accordingly then we have to do the calculations. Second year it was 62,000 units were produced. So we could have done this calculation even without putting it manually. We could have just entered the cell reference, which I will do it now. So assumption divided by, what was the thing? So here we had, let me just do it once again for you. This divided by, which is actually 15,000 divided by 60,000. Actually it should have been that, right? Divided by total production, divided by total production, multiplied by total production cost. Then equal to, we could have taken this into consideration, and for the closing stock we can again do the calculation here. So we took this. Now if I do copyright, am I getting the correct result? Let us check. So now this has considered this figure, and if you would like to check what it has taken, it has taken this closing stock, of, you can check it, right? From PL, see, assumption it has taken E42 and assumption E38. E42 it has taken, E42 is that it has taken, and E38 it has taken, right? So these are correct. So it should be what? If you check this formula and compare it with this one, you will understand it, I think. Are you understanding it? We just did this thing. Check. We have multiplied this thing along with what? The closing stock divided by the opening stock. We have done just this thing. Closing stock divided by this total production, opening stock, closing stock divided by this total production multiplied by, we have done this price to get the price of the closing stock. I don't think, probably you guys are not getting it. Let me just try to help you with something. Okay, I'm not finding it out for you. It's okay. I'm just showing it to you what I am actually trying to mean. I am saying that equal to closing divided by opening multiplied by total production cost. I am telling you just this. I am I'm telling you just this, closing stock divided by opening stock multiplied by total production cost. In order to understand what is the value of the closing stock. I think now you have understood, right? Closing stock divided by opening stock multiplied by total production cost. Because I want to know what is the closing stock. This is not opening stock, I am telling you wrong. This is the total production. Now it is correct. Closing stock divided by total production into total production cost. This is the total production data I have taken. So opening stock divided by total production multiplied by this production cost I am taking. So if you copy it right, check, it is now okay. So like this, I have got the value for this closing stocks. So now the opening stock and closing stock has been calculated. Now let us look for the COGS. Cost of goods sold. What it should be? It should be total production cost plus opening stock minus the closing stock. Again, Control R, copy right. Total production cost plus opening stock minus closing stock. So this is your cost of goods sold. Now then, what should be the gross profit? What should be the gross profit? Gross profit should be what? At what you are selling minus your cost. So at what price you are selling here? You are selling at this price 6750,000. So what you should do? You should just eliminate so this is the one thing you should consider is that what is your selling price? It is 67,50,000. This is your amount of sales. So from this thing, what you should do is that you should minus the COGS part. So if you eliminate COGS from it, then you will get it. So sales minus COGS you have to do. So sales price is given there minus COGS is given here. You can just Control R. You can just make the entire thing look bold. Alt OCA. Then for putting a border, Alt HB border. For the top border, press P. Gross profit has been calculated now. So as you have already deducted the direct expenses, now what you will left with is the indirect expenses. So just do less indirect expenses. And what are this? It is sales. It is sales commission. So sales commission. What is the amount of the sales commission? Sales commission was at 8%. You remember it, right? So we can just take it. I'm just checking whether I have any inputs here in the assumption sheet. I think I just included, yeah, only the 8% I included here. So anyways, I can take it from here. So we should actually avoid hard punching any data in the profit and loss, balance sheet and cash flow, because it should be dynamic, right? So sales commission should be calculated on the basis of the sales that you have made multiplied by control page up this 8% fixed. Press enter, control R, alt O C A, alt O C A. So sales commission has been calculated now. So next thing is SG and A, that is selling general and administrative. It was like somewhere around 12 lakh 60 or something. So we, yeah, it was the 12 lakh 60 SG and A expenses, that is selling general and administrative expense. So we can simply link it. We can simply link it here by doing, just a second, yeah. So this is the thing now. Control page down, yeah, equal to control page up, selling general and administrative expenses. I'm just linking it because it has already been calculated, because we had some assumptions, some estimates about it, right? So SG&A expenses is given here. Then what is the amount of total indirect expenses? Total indirect expenses, alt equals shift right, control R. Total indirect expenses has been calculated. So as now you have already calculated total indirect expenses, alt HBP. So now what you can find out is the EBITDA, EBITDA. EBITDA you can calculate now. So now how to calculate EBITDA from this thing? Try to do it once by yourself, because I have already given you all the inputs that you may require. So all the things are already given here. You can see it. There is no extra information given here. Whatever is required in order to calculate it is completely given here. Just like, try to figure it out what we are going to minus from the given figures. What should we do minus? We have total indirect expenses. So if we just deduct it from the gross profit, we will get the EBITDA. Very simple. I think you have got it 100% correct also by yourself itself. So yeah, that is going to be our EBITDA. EBITDA. EBITDA we have got. This is a very much important thing. So definitely you have to put it in bold. Alt HBP. Now after EBITDA, what you can do is you can minus the depreciation. You can deduct the depreciation part. So less depreciation equals to, now depreciation, for the depreciation part we had a schedule for depreciation, right? We made a schedule for depreciation. Net block opening, yes, the depreciation schedule. we can simply link it. Depreciation schedule has been linked. Depreciation has been linked. Now, if from EBITDA I am deducting the depreciation part, what I am left with is EBIT. How to do it? EBITDA minus depreciation, control R, alt HBP. Just you can make it bold by pressing control V. EBIT part is done. Now what we can link here is that less interest. Less interest. Now here is something really interesting about it. So what interest rate and why you should be selecting it? So think about it. In our assumption sheet we had this thing in the interest schedule. Yeah, this one. So if it is 10%, if it is 12%. So we had these two conditions here. So what we can do is that now the interest coverage ratio was what? It was 8.5x. It was 8.5x. So we have to now check it whether this EBIT is enough for 8.5x interest coverage ratio or not. So about the interest, in our assumption sheet we actually didn't build anything significant, right? We just had this thing and we had this thing blank, interest coverage ratio. Now we do have the EBIT amount, so we can definitely calculate this thing. We can calculate the interest coverage ratio and check that which rate it would actually suit. So we should actually do the work using this 10% rate. Why this 10% rate is that? Because this is the base rate which we decided along with the bank after discussing with the bank. So let us now do it. Interest coverage ratio, how we can calculate it is press equal to EBIT divided by control page up, press this, check this one 10%, press enter, and this is the interest coverage ratio of 5. Control R. So you can see interest coverage ratio means it is EBIT divided by interest. So here you can see that the interest coverage ratio is actually quite good, but in the first year the interest coverage ratio was 5, which is less than 8.5 criteria. So in the first year what interest we will have to pay is that equal to, if we have to put this if function, I was telling you ki, we will be using this if function very often, so we are using it. So if what, if this is less than 8.5%, if it is less than 8.5, then if it is less than 8.5, then what? Then this interest we will have to pay, or else we will be paying this interest. Press enter, shift, control R. Now wait, let me explain a few things. We did it right, but let me explain this linking formula that I have used. Okay, the formula that I have used. So the formula I have used is that EBIT less interest, right? So interest, how to choose which interest will actually be applicable. So here we already have calculated the interest coverage ratio, right? We already have calculated the interest coverage ratio. So what should be our interest amount? Interest amount should be if the interest coverage ratio is less than, keep following this formula bar. If the interest coverage ratio, I'm doing it once again, if equal to, if the interest coverage ratio, here it is, interest coverage ratio, if it is less than 8.5, keep following this thing, if our interest coverage ratio is less than 8.5, then we will pay 12% interest. If it is not less than 8.5, then we will pay 10% interest. Shift, close bracket, enter. Shift, Control R. So you can now manually check it also. It is more than 14%. So how much we should pay? 1,20,000. We are paying how much? 1,20,000. Why it is 1,80,000? Because it is 5%. So 1,80,000. Like that. So this is the EBIT less interest part. Then what is coming is that earning after tax. Earnings after tax equal to EBIT, earning before interest and tax, minus interest amount. See, here it is showing a green inconsistent formula. Why it is inconsistent? Because it is not as per the normal standards. We had to take this formula. Control R, you can check. We included this if formula. Now let me tell you one thing. Why this green corners are getting highlighted? Why those green corners have appeared? Is because we were like working with some normal formulas like additions and page linkings and everything, but here we have included, we have made this, use this if function. So this is why it is showing this, and it is showing as inconsistent formula. The formula in this cell differs from the formulas in this area of the spreadsheet. It is showing this. So it is just giving us an early notice, but yeah, we know what we have done. So Alt H B P, earning after tax. Now we can calculate net margin because we have to do something with the dividend part also. So net margin. How to calculate this net margin? You know that EAT divided by this one. EAT, that is earning after tax, divided by what? Earning after tax divided by turnover, that is our sales. I've done it. Earnings after tax divided by the sales. Net margin is 8%, 16, then 18, then 20, then 21. So now we had one condition, right? Regarding the dividend policy, we had something. Dividend, if net margin is greater than 10%, then 25% dividend or 0. So less dividend. So if the net margin is, if the net margin is less than 10%, then 0, or else what will happen? Or else we will give earning after tax multiplied by 25%. So this year it is 0. This year it is definitely 0 because it is 8%. Okay, yeah, we have to fix those formulas, and then page up, we have to fix this thing. Control page down. If D5, that is 8%, is less than 10%, then we give 0 dividend. If it is greater than 8%, then what do? We give this earning after taxes 25%. So this thing we have to actually fix. That is this 25% thing. मतलब this dividend का rate. So this is the dividend appearing. So if you would like to check manually, so 25% of this should come here, equal to this 25%. This is the same amount, so it is correct. You can keep checking these things like that. If you are doing it for the first time, it should be not even for the first time only, you have to keep checking these things whether you have linked the formulas correctly or not. It is good to be 100% sure, right? So the dividend part is done, then profit transfer to reserve. Profit transferred to reserves, how much? It should be earning after tax minus dividend, control R, control B, alt HB P. Now okay, I can use this thing, alt HB, top and double bottom border, so U. Yeah, this looks better. So the profit and loss statement is complete. Profit and loss statement is complete for us. You can see it. The profit and loss statement is complete. Now what we can do? OCA. Yeah. So what we can do next? We can do the balance sheet and cash flow. Now we can cover the balance sheet and cash flow. It would take very less time to cover balance sheet and cash flow. I know that it has been almost 3 hours of session, but yeah, it's okay. We cannot do it differently, so it's okay. It is equity and liability. So we are starting with a balance sheet. Let's make the format. Equity and liability. Here equity, so you can just make it bold, equity and liability, then equity, then you can also make it bold. Under the equity head there will be equity share capital, equity share capital, securities premium. So we can put these things now in place. Control page up. So we did this thing here itself. Equity share capital, and we can put this thing, securities premium, and control R. We can do it not like that. It should be done in a manner. So this thing will remain fixed, this equity share capital and securities premium, because no new issues were made. So we can keep it constant as it is, control R, alt O, C, A. Now what we have in the equity part is that the reserves and surplus, right? So the reserves part, from where we get the reserves, we just have calculated profit transfer to reserves. So profit transfer to reserves, but there is a little fun element attached with this thing, so which we have to be careful about. So this is the first year's reserves transfer, right? Profit transfer to reserve. This is the first year's thing. But from the second year, what we need to do is that we have to not only transfer, but next year what it will be? It will be equal to this plus this thing, and then you can just copy it, right? Have you understood? इस साल में आपका प्रॉफिट एंड लॉस स्टेटमेंट में जितना भी प्रॉफिट हुआ था ये तो रिजर्व को जाएगा ही जाएगा, बैलेंस शीट में गया भी है, देख लीजिए. बट नेक्स्ट ईयर में ये जो रिजर्व बैलेंस शीट में ट्रांसफ़र होगा तो वो तो पिछले साल का रिजर्व इस साल रहेगा, उसके साथ इस नए साल का रिजर्व आपका प्रॉफिट रिजर्व में ट्रांसफ़र होगा. सो दैट एडिशन यू शुड डू एंड यू शुड डू इट प्रॉपर्ली. ओके, तो एक शॉर्टकट लेट मी टेल यू so that you can just do it with one formula itself. Press equal to control page up, click on it, plus control page down जाइए, select this blank page, cell. Now if you just do control R, shift right and control R, automatically it gets calculated. Why? Look at it. It is considering this plus E27. See, PL का it is taking E27 यहाँ से and balance sheet का D6. This is the D6 and PL E27 it is taken. E27 it is taken. Okay. So this was the shortcut for results. How did I do it? Let me show you once again. If you are like confused about it, it's alright. Let me just show you. Press equal to, simply press equal to, control page up, go and select the profit transfer to the reserves, then just do plus this blank area, shift right words, control R, your job is done. So this is the total equity, T-O-T-A-L, total equity. This is your total equity. How to do it? Now equity share capital, you can just do simple alt equal to, and this is the result, control R, alt O, C A, total equity. You have got the total equity amount, right? Now what to do? Now this is the time for liability. The time for liability. So in the liabilities, what was there? There was non-current liability, that is loan, and there was current liability. So in the liability section, you can make it bold, and here you can write non-current liability. In the non-current liability section, you had the debt ka balance in the assumption sheet. Non-current liability में you had this debt schedule and the closing balance of that debt schedule, you can put it here. So this is the non-current liability part, now after we are done with the non-current liability, then what should I do? Then we should look at current liability. This is the non-current. Then current liability. In the current liability part, what is there? In the current liability part, we have creditors. We have creditors. In the current liability part, we have creditors. Creditors, how much? It was, see, in the creditors we had one thing of normal creditors for raw materials and another one for outstanding expenses. So here creditors means I am talking about that raw material. Raw material वाला creditors. So where are they? Creditor कहाँ है? Creditor days are mentioned. When creditor days are mentioned, from this thing you can actually calculate the creditors amount. So what used to be the raw material purchases? Did we make any creditor schedule here for linking? No. It's okay, we can directly just do it. We have the creditor days for 60. So raw material price, it is 60, and raw material quantity purchased. So for the production, so total production, so this much raw material you have purchased every year. Every year you have purchased this much raw material, right? If you have purchased this much of raw material every year, so creditors equal to, it should be like 60,000 units was the total purchase throughout the year. 60,000 units of raw material you purchased throughout the year for the production, because you have produced 60,000 units, so that is the amount of raw material you have purchased, right? Multiplied by raw material price, which is 60. Now the creditor days are 60. So if you put these things in a bracket, then if you try to do it, this would work. You have 60 days for 60 days as creditor days. If you do multiplied by, but this was your what? This one, if you press F9, shift F9, and if you try to check, actually it is in the assumptions, so probably it won't work. So this thing is actually assumptions D38 multiplied by D48. What is this? D38 and 48. D38 was my total production quantity multiplied by raw material price per unit. So this is the actual amount of raw material that I have purchased. So this is the for the entire year. Let's say it was 1 lakh. Now 60 days you are paying the creditor after 60 days. That means last 60 days ka, if you like make it like 60,000, you have purchased raw material of 60,000 units. तो उसका पूरे साल में आपने कभी ना कभी खरीदा होगा उसको, तो ऑन एन एवरेज पकड़ लेते हैं कि आपने पूरे साल में इक्वली डिस्ट्रीब्यूट करके यू हैव परचेज द रॉ मटेरियल. नाउ व्हेन यू आर डूइंग इट मल्टीप्लाइंग बाय 60 बाय 365, दैट मीन्स 365 से डिवाइडिंग मतलब डे, मतलब एक दिन का रॉ मटेरियल का कितना खर्चा जा रहा है, multiplied by 60 days का, because that is the 60 days period you have got, creditors period, right? So this is the creditors amount will be here, control R. Now we have another kind of a creditor, which is some kind of outstanding expenses. Outstanding expenses, that was something like that, 1.25 something it was there. I think we have included here outstanding expenses days in months, which is this. Now outstanding expenses of what? That is a big deal. Outstanding expenses of what? That is the main question. So if you check this thing, if you just check, so you had this thing here, outstanding expense account for 1.25 months. अब this is outstanding expense, मतलब this is not the direct but the indirect expense. तो SG&A का कुछ था हम लोगों के पास, yeah, this is the portion. So on this we can apply this. So it is there, let me, so outstanding expenses, you can do it as equal to, go to PL, then you have this SG&A divided by 12 multiplied by 1.25 months. So this is your outstanding expenses. Outstanding expenses, you can link it now to outstanding expenses. How did I do it? 12 lakh 60 it was, 12 lakh 60 it was. इसी का we did, we took this thing 12 lakh 60,000 divided by 12 into 1.25 months का था, right? It was of 1.25 months, 1.25 months का, so we just took it. So outstanding expenses, then और क्या रहा अभी, outstanding expenses we got it, then the total liabilities part. Total liabilities कितना होगा? So total equity plus this two equal to, then it is your total equity plus non-current plus this, or simply you can even use a sum function also here, it's up to you. So this is the total liability part. Alt HB U CA. So this is the total liabilities part. Now asset part. Let us look at assets part. Here let us do non-current assets. In the non-current assets, what is the thing? It was machinery. It was machinery. Non-current asset में it was machinery. So press equal to, control page up. नॉन करंट एसेट में it was machinery in the assumptions. Non current asset it was my machinery. There was the net block amount, and the charge of depreciation was given there. Machinery. So it is the net block, then you can make it bold, up to you, control V. Then you can do current assets. Current assets. Current assets, what you can do? You can do inventory. Inventory. Did you have any inventory in this assumption sheet? Did we have that? We had just the quantities, right? So I'm going here in the profit and loss statement. Yeah, because we have this closing stock here, so we need the closing inventory only. So I'm linking this inventory from this part because it was in values, right? It was in value terms. So closing inventory, you can check how it was calculated. It is correct. So we have taken it from the profit and loss statement. Now after the inventory there is debtors. There is debtors. Debtors. With the debtors there were some conditions, right? We had some conditions with the debtors. That there was, I think, with the debtors we had 40 days period, I guess. So debtors were at those. Yeah, debtor days were 40 days. So 40 days of what? 40 days of sales. 40 days of sales. So you have to get the sales first. This is the sales amount divided by 365 multiplied by how many days of sales? Debtor days was this. Okay, this link was not properly established. Okay, wait. I'm doing it once again. Equal to for the debtors. I'm going to the profit and loss statement, linking the sales part, dividing it by 365 into multiplying it by debtor days. Then I have got the debtor amount, the sundry debtors amount I have got. Now cash and bank balance. Cash and bank balance. I'm supposed to get it from the cash flow statement, so I will get it from there. So total current assets I'm supposed to calculate here now. Total current assets. Total current assets I have got. So the thing is that now I should do the total of it. definitely the balance sheet wouldn't tally because the value has not come from the cash flow yet. So equal to total current assets plus this amount. So this is the checkpoint. Checkpoint means equal to, I'm eliminating total liabilities minus total assets. So this much of cash should be there. Now I have to calculate the cash flow statement. I have to make the cash flow statement. Now how to make the cash flow statement? It is going to be pretty simple. Not too much of a complicated stuff. I know this session is getting really long. It is already more than 3 hours, but it takes that much time. It definitely takes that much time. Right, okay, the cash flow will get over very soon. Operating activities. Profit after tax. So how much is the profit after tax? We can simply link it from the profit and loss statement. It is there. Earning after tax, get it. Get the data. Then profit after tax is here. Now what is the next item? Now then we will add the non-cash expenses. Add non-cash expenses like depreciation, so what was the depreciation amount? Equal to, you can just take it from here itself if you want, it's alright. Depreciation amount. Then what you should add back is interest, because this is not an operating expenditure but a financing activity, right? You can link it from here itself, no problem. Interest, we have taken the interest part. Now cash before, impact of working capital we can get. This is the cash before, cash flow from operation before working capital changes. So cash before working capital changes. Now in the working capital changes, how it can change is that we had creditors, we had that outstanding expense, debtors, and we had inventory, right? So we will just put those things here only. So one by one let us put it. So let us put it, let's put here the creditors part. Okay, let me just calculate this thing. Alt equal to let me just do it like this. equal to sum this comma this is to this, putting enter, shift right arrow control R. So this is the cash before working capital changes. Now what are those elements? What are the current assets and liabilities we have is the creditors part. So the creditors part is equal to, you can go and check in the balance sheet side that what has been the situation for the creditors. So non-current liabilities, this is the non-current, so we have to be focused on the current part only. So first year the creditors was this minus this year's creditor minus previous year's creditor, that is the changes in creditors, right? There is the changes in creditors. Now if the creditors balance goes up, it is good because it shows as cash inflow, right? So I can put it in a positive sign that this is a cash inflow. I can drag this formula till the end. Now after creditors, what else is there? Is the outstanding expenses. Same, it is a like current liability. So same thing we can do just like that. What was the line item? It was outstanding expenses. So outstanding expenses, we can use the same formula here also. You can check it if you want. It has taken this formula, shift R. Okay, so this is the impact of the current liabilities. Now current assets, how it has impacted this thing, let us see. So we had current assets, those were inventories and debtors. So inventory and debtors, these were the two current assets we had. So just take down the names. Inventories and debtors, these are the two things we had. So now if inventory goes up, is it cash inflow or cash outflow? It is definitely cash outflow, right? So what we can do is current year minus the previous year, and this is the changes. Now this change I should denote it using the negative sign. Why it is so? Why I am denoting it in the negative sign is because it is actually negative. It is actually the cash outflow. It is actually the cash outflow. So this is why I have denoted it in the negative sign. Now is this formula correct or not? We have to check it. So a little bit of sign change is required here. So we will do that. It should be, see, while you are putting any negative sign or anything, then you have to be really very much careful about it. Okay, so here actually the impact has been cash outflow. So whatever the result is, you can just simply do it. You can put a bracket. And then you can do it. Then it would be, I think, very easy to use. Otherwise this thing can get messed up very easily. So now it is showing balance sheet E22, balance sheet D22. So let us go there. Balance sheet E22 minus balance sheet D22. So it is correct. Same with the debtors. Same formula applicable for the debtors. What did I do in the formula? Let me just show you once again. I just pressed equal to I put a minus sign. Why minus sign? Because it is if the if the current asset is going up, it is a negative thing because it is a cash outflow for me. So this is why I'm putting a negative sign. So now page up, we have the debtors minus this thing I am taking. Why I am taking? You already know it, because next time as it moves rightwards, the force also will move rightward like this. यहाँ से यहाँ, यहाँ से यहाँ मूव करेंगे. तो after the debtors, cash flow from operating activities, I can find it out now. Cash flow from operating activities. What should be the answer? It should be what? It should be sum of all these things. It should be a sum of all these things. If you sum it up, this is the negative cash flow it is showing. Why it is showing a negative cash flow? Because in the first year the inventory was too much, so it was actually a cash outflow. Negative cash flow means what is happening is that it is a cash outflow. Cash flow from operation, it was in negative first year, then it shifted. Now it is the turn for investing activity. In the investing activity, what happened? We just purchased machinery. We didn't dispose it of. So, from where you should be taking it? You can take it from that capex schedule. So this is the investing activity thing. You can take it directly from the assumptions. Asset schedule, fixed asset schedule, why I am taking the capex part? Because this is what actually has made the cash outflow, right? So this is what has actually made the cash to go out of the business. So I'm putting a minus sign because this is a cash outflow. Control R. This is a cash outflow. Cash from investing activity is how much? Sum of only this. Sum of only this. So now this is the cash from investing activity, and this is the last thing, which is financing activity. We need to do this thing now. Cash flow from investing activities, it is done. Now financing activities. Financing activities, in this thing what is there? We have interest expenses, we have interest expenses, which we actually earlier on removed it. We can now add it on here. So interest expenses, we added it back there Now we can remove it from this because it is actually a financing activity cash outflow. It is a financing activity cash outflow. So interest expenses, we have to put it in negative interest expenses because it is a financing activities cash outflow. Outflow means minus. Then financing activity, then what was done, then issue of we issued some equity shares in the very first year. So issue of share, we issued some shares. So from where I can get the issue of shares is that from the assumptions I can I should take it from assumptions, I feel so. issue of shares issue of shares here it is showing only this. Achha, here तो नहीं दिखाएगा. Then balance sheet total equity, no, not this one. Okay, we can just add it, no problem. So what we can do is that we can simply add this plus this, or more technically I can take it from this part also. It will be alright. Assumptions part, this plus securities premium, no problem. So yeah, issue of shares was of this amount. Next year we didn't issue anything, so we are not dragging the formula anymore. So issue of shares is done. Then loan taken, yes, definitely we took loan. Loan taken was of how much amount? 15 lakhs. So where it was in the balance sheet part also. Yeah. So okay, we can take it from assumption. I think that will be good. Loan taken, this much only. After that we didn't take any loan, so we are not concerned about that. Now loan repaid, definitely we repaid loans. So these were the cash inflows. We took loan, we issued equity shares. These were the cash inflows. So this is in plus, interest expense, this is in minus. Now loan repaid. Loans repaid. First year there was no repayment of loan. Debt schedule, debt repayment schedule, loan taken during the year, loan repaid. Here first year there was no repayment, so I can put a minus here because this is the cash outflow part, and I can do control R for this thing. Loan repayment, yeah, 3 lakh 360 to 05,800. See, so this is the loan repaid. I have linked here the loan repaid part. From where? From the assumption sheet I linked the loan repaid part. Loan repaid part. Now what is left? Now the dividend amount that we paid, that is only left. So dividend, where did we pay the dividend? In the PL statement we paid the dividend, so we can link it from here. But yeah, don't forget to put it a minus because that is a dividend paid cash outflow. So dividend paid, cash from Cash from financing activities. Cash from financing activities. How much cash from financing activities has taken place is it is a sum of financing activities, all those things. Control R. Cash from financing activities. We have done now cash generated during the year. How much cash was generated during the year? Let us calculate now. Cash generated during the year. So this is supposed to be cash generated during the year is supposed to be cash from financing, cash from investing, cash flow from operating activities. This is the cash generated. I added in the cash generated part, I added all the cash flow from operating, investing and financing activities. I have added them all. Now here what I can do is that closing, sorry, so the opening, add opening cash balance. Add opening cash balance. Opening cash balance in the first year was 0. Then later on it happened. So how should I like link it, right? So opening cash balance there was 0 in the first year. I'm leaving it out. Next year there was something. Now put it closing cash balance. Closing cash balance is equal to cash from financing activities. No, so yeah, cash generated during the year so this is for the calculation of closing cash balance. So this is the net cash generated during the year. And if there was any opening cash balance, now the opening cash balance would be this one. So this is the this plus this. If we put it here, this is becoming 910. If I drag the formula, what is happening is taking this, and if I drag this, this is taking this. Now closing, check all the closings once. It seems correct. So now the main judgment part. Is there any mistake in whatever we were doing? Now it is the main judgment part. Cash and bank balance. If we put the balance, what will happen? Closing cash balance. I am putting it cash and bank balance. Look at the check. If it is correct, it will tally, otherwise not. So it is fortunately correct. So all the things that we have done, all the formulas that we have put was 100% correct. This is why total assets has become equal to the total liabilities, and this check post was total assets minus total liabilities. So it has become 0. That means it is absolutely correct. So all our hard work has now paid off. We have made a successful, we have made one model where we have done everything from scratch for a new business, right? So Alt HB U. So now like that you can make it a bit presentable as you want it to be. You can make it a bit presentable like Alt H B P for the top border financing. This is investing ones. Alt H B P for this one cash from your cash flows. Alt H B P. Alt H B P. So this is also bold. Cash before working capital changes. You can like that make it a bit presentable as you would like to design it, and then the closing cash balance. Alt HB U. So this is how you can make it. So we still have a very small portion left of the break-even point, which I am not teaching you right at this moment, although it was a part of the question, but still I am not teaching you right now. This only small part is left. This is just a very small part. Should I teach this thing today itself? Okay, leave it for now. Leave it for now. Uh, I will teach this thing later on with some more better examples. Okay, so I will share all this, this PDF and the Excel sheet with all of you. So don't be worried about it, and please, keep practicing these things. I know this session was like quite long. I myself has even been, continuously recording this, sitting down at one place for 3.5 hours. Like speaking continuously for 3.5 hours, how difficult it is, right? So yeah, I have done it. Please do your practice and learn it. Okay, all the best.